Our first presentation this afternoon is Land and Legacy Tax Strategies for Farm Succession. Michael Poole is a partner and a tax leader for MNP's Southern Manitoba region. Working out of the branch office, Michael delivers comprehensive corporate and personal tax services, helping clients stay compliant and reduce their overall tax requirements. Michael provides specialty tax strategies to clients of all sizes and in a wide range of industries, including agriculture and oil and gas. Skilled at explaining complicated tax issues so that clients can make informed decisions. Michael draws on more than 15 years of experience and knowledge to deliver creative, practical solutions to unique business challenges. Welcome, Michael.
Thank you very much. Okay, welcome to day one of Ag Days, and thank you for coming out this afternoon and spending some time. Today I'm going to be talking about land and legacy, and it's always hard to come up with a good topic because there's so many things that we could talk about when it comes to tax with respect to ag. And the other thing that makes it tricky is there hasn't been a substantial change to the rules in quite a few years. So we have talked about land in previous Ag Days presentations, but I just wanted something that is relevant for the time and that everyone will get something from. So what I started with was a little bit of research, and what I found was pretty shocking. So $50 billion in farm assets are going to change hands in the next 10 years. That's incredible. And when I did a little bit more research, I found out that on average, farmland makes up 80% of a farm's value. So if we do some quick math there, we're talking about $40 billion worth of farmland, that's going to change hands in the next 10 years. That's incredible. I also found out that about 25% of farmland is held corporately, 75% is held personally, so this impacts you whether you are holding your land corporately or personally, so we throw that in there. And we know that 67% of farm families are looking to transition to the next generation, so this really fits the bill. The thing that I think that was most surprising for me is that there's only about 12% of farm families that have a written down, documented plan. And so if we do the math on that, that says there's somewhere in the neighborhood of $35 billion worth of farmland for which there is no plan for transition, retention, and for sale. That's very frightening. So that told me right away this was the topic for today. So what are we going to talk about today? We're going to get into farmland history because that drives the bus. That's everything when it comes to looking at these rules, these special tax rules that are available. And I put things into three different buckets. So a pure farm transition, so we've identified a successor, the land is going to go to that next generation, or maybe it's shares of a corporation that own land. Then I looked at farmland retention and rental. So maybe you're not looking to transition right away. You want to hold on to that land, though you're not ready to sell it. So you're going to rent it. It's going to supplement your cash flow. And you could be renting to one of your children who is farming, or you might be renting to the neighbor. And that makes a big difference. The last bucket is just a straight sale. So you haven't identified someone for transition, or maybe you got the land in a transition. You're not into farming, and you're looking to sell the land. There's a completely different set of rules when we look at that. Then we're going to look at some common traps that people can get into. And the thing about CRA and these traps, they're not set intentionally, but you can absolutely walk into them, and you might find out that it's too late to take advantage of some of the planning that's available in the Income Tax Act. And then at the end, there's a call to action. So farmland history is where it all begins. Whether we're talking about transition to the next generation or using your capital gain exemption, the rules that we look at in the Income Tax Act, they drive 100% off of the farmland history. And so this is where we have to start. And you're going to see this again at the end. This is my call to action. This needs to be done because I can't help you unless I know the history of the farmland. And there's a lot of details there. You have to do this on a parcel by parcel basis. And what I have found over the years is that families tend to think of the land all as one large amount. And they think of it's all as old as the oldest land. It's been in the family for 100 years. But that's not true. There could have been some that's been in the family for 100 years and some that's been in the family for 20 years. And that makes a huge difference. Really small variations in the farmland history can have a huge impact on whether or not you're going to be able to transition that land, use your capital gain exemption, or both. So this is very much a devil is in the details type of a scenario, and we need to get this right. And of course, Department of Finance isn't going to make it easy, so the rules are complex. They're different for land versus shares. They're different for transition versus capital gain exemption. So it's a real minefield. So what does a farmland history look like? It's really just a checklist. We want to know who owns the land today, and that's not always clear. Don't necessarily rely on your property tax statement. They're not always 100% right. They're pretty good, but it's always good to go back to the lawyer's office and find out who's on title and make sure about it. Then we have to look at the ownership history. Who has owned the land? When's the first instance that it came into the family? Was it great-grandpa? Was it grandpa? Was it dad? Who bought the land initially? And while it's been owned by various family members, who's been farming it? Did grandpa farm it? Did you farm it? Did dad farm it? Did uncle farm it? All these things make a huge difference in the outcome. Then we have to look at, has the land been rented ever? And if it has, who's it been rented to? Well, if you've rented it to your own farming corporation, or you're renting it to a child, that's not very problematic. If you're renting it to the neighbor, however, that could be a problem when it comes to the overall ability to transition that land or use your capital gain exemption when you sell that land. So here's just an example of what a farmland history could look like. If you own Northwest 2315-9, this was just made up. So don't get excited. So we're going to say the land is currently owned by Arthur. He got the land from his father, Pete, in 2000. Peter purchased the land from his uncle in 1993. And Garth, the uncle, he inherited from his father, Andrew, in 1980. And Andrew bought it in 1928. So from 28 to 1965, Andrew farmed the land. He was a sole proprietor. And then he started renting it to his other son, Alan. So Alan and Garth are brothers. Alan rented the land from Dad and his brother for a period of time until about 92. And then Peter farmed the land personally from 93 into 2000, and then it was gifted to Arthur. So this is what it would look like. And you would do this on a quarter-by-quarter basis. And this is the information, this is the detail that I would need to tell you whether or not this land qualifies for transition, capital gain exemption, both, or neither. So let's talk about the first bucket. Let's talk about transition. So we've done our farmland history. We've gone quarter by quarter. And we're going to look at, can we transition this to the next generation? What this allows you to do is take that land or shares of a corporation that hold land and transfer it to the next generation. And when that happens, you can do it at cost, original tax cost. Basically, you can gift the land to the next generation, and there is no cost to doing that. There's no tax cost to mom and dad. There's no tax cost to the kid on that transaction. If it's not the most powerful tool in the Income Tax Act, it's got to be up there because there's no limitation on the value that you can transfer. So we know if we talk about our capital gain exemption, it's $1,275,000. There's a limit to it. If you have a $20, $30, $40, $50 million farm, land and shares, and you want to transfer it to one or more of your farming children, you can do that. So that's why I say this is a very powerful tool, and that's why it's so important that we do our land history so we understand, is this rule on the table? Are we getting close to falling off the table? If we don't qualify today, what can we do? Is there anything we can do? So I've looked at it from the perspective of farmland versus shares of a farm corporation because my initial look into the information says about 25% of land is owned corporately. So let's look at both of them. In general, if you want to transition your farmland to the next generation, we need more farming years than non-farming years by eligible persons. And so in context of me, if I own land, I'm an eligible person. My children and grandchildren, my parents and grandparents are all eligible users. But a brother is not, sister, niece, nephew, aunt, uncle, their use of the land that I own today, not qualified. It has to go to a child resident in Canada. So that's important. If you got kids that are, maybe taking some education down in the States, If the plan is to gift them the land and they decide they don't want to come back to Canada, that plan's not going to work without tax. The nice thing with farmland, if you own it personally, is you can make a decision on a parcel-by-parcel basis, and we do the analysis on a parcel-by-parcel basis. So you could say this parcel maybe goes to this child, that parcel goes to that child. And the qualification of one parcel is independent of the qualification of any of the others. So if you own 10 quarters and one of them doesn't qualify, we're only worried about that one quarter if we're talking about owning that land personally. But let's switch gears now and let's talk about what if the land that we're wanting to transition is sitting in a corporation. So we had a farming corp, it's got land in it, we want to transition that land. In order for that to be done, the corporation has to meet the definition of a family farm corporation, which means 90% or more of its asset value has to have been used at least 50% in farming. And the nice thing about this rule is you can go back 2 years before the corporation owned it. So if it was originally homesteaded by great-grandpa and it has now found its way into your farm corporation, you can use all of those years as potential history for making it qualify. Again, it has to go to a child resident in Canada. And the one downside, though, with having land in a corporation is that, again, if we go back to that same example, I got 10 quarters and one of them doesn't qualify. Well, if that one quarter has enough value to put me offside my 90%, all of the shares don't qualify. And that's huge. So if you own it personally, one bad apple doesn't spoil the bunch, but if it's in a corporation, that may not be the case. So let's look at a scenario where we're going to retain the farmland. And who knows what our goals are, but we're going to retain this farmland. Maybe we want it to go to the next generation because we feel like there's a legacy there, even if those kids aren't going to farm. Maybe those kids are going to farm, but we just want to hold on to it for a little while longer so we can take the rent off of it. That's going to supplement some retirement income. So that's an option. Or maybe we're going to rent it to the neighbor and we don't know what's going to happen. Maybe we're going to sell it in the future. We're not sure. What you need to be aware of is the impact that those those renting years has on the land history. And so if you've owned the land forever and you've got 75 years of farming history, no problem, you can go and rent it for 10 years. But if you've only owned the land for 10 years, 10 years of rent puts it offside. So it's very important, again, I go back to that land history. I'm going to sound like a broken record today, but it's so important because that's what drives the bus. Interesting, when it comes to the next generation, they typically don't have to farm it to be able to use their capital gain exemption. So that's a common misconception that's out there. They think, oh, my kid has to farm it to use their exemption. Not necessarily so. But what you might find is that next generation, they can't do a transition to the next because our rental years have added up. So again, I'll do the same sort of side-by-side comparison when we're talking about whether that land is owned personally versus corporately. You have to be very careful. Rental years don't qualify as farming years. And so one of my earlier slides, we talked about more farming years than renting years. You got to be careful here. You have to know the history of the land. I'm going to warn you about crop share and what I've put in quotations, other arrangements, to try to make rental into farming years. I'm not saying that it can't be done, but it's very difficult. And just by saying I'm doing a crop share, that doesn't mean you're necessarily farming it, and it doesn't necessarily mean you're farming it enough for that year to qualify. So be very careful of those. So what might you have to do? Well, if some of your land is getting close to no longer qualifying, maybe you have to accelerate your plan. So maybe the land goes, one or more parcels goes to one of the kids sooner than later. Get it in under the wire, so to speak. You have to be careful when you're reporting the rental income. So if you own it jointly with your spouse, you own this land jointly with your spouse, however, one of you was added to title at a date after it was, say, inherited, we have to make sure that all that rental income is going back to the original owner. And I'll talk about this in context of sale as well. And one thing to think about here is if you have land that's about to go offside or be disqualified from a transition to the next generation, an option could be that you transfer them the title, but you as the parents hold on to what we call a life interest, which means you get all the rent going forward. And then on your passing, the land transitions over to your child. So that's a good strategy for personally held farmland. Now, if we flip it over to corporately held land, it's the same sort of story. The rental years don't qualify. You got to be careful of crop share and other types of arrangements. But again, going back to that comment I made earlier, one bad parcel of land can disqualify all of the share value. And so a lot of strategies that we have when we're talking about land in a corporation is we're trying to get those bad apples out. And we do have strategies. We can maybe move an offside quarter to a separate holding company. Another strategy is if you hold land personally and corporately, maybe we can do a swap. So swap a good quarter in and take a bad quarter out, and then it brings the company back on side again. So we do have strategies, but we can only implement them if we have enough time to implement them. So again, that's the importance. You got to do that farm history and get in front of somebody that can help you analyze it and troubleshoot some issues that might be there. So the next bucket is a sale. Now, whether this occurs right when you're done farming, so we're done farming, we've sold off all the equipment, it's time we're going to sell the land, or maybe you've rented it for a few years and now you're ready to sell. Whether or not you're selling land personally or you're selling land that's in a corporate structure, the main thing we're going to be looking at is your lifetime capital gain exemption. It does have a limit, so it's $1,275,000 in 2026. Every individual gets that, but you only get it if you dispose of certain types of property. And what we're talking about today is qualified farm property and shares of a family farm corporation. We have to be careful when we're selling, though. Even though we're going to use our capital gain exemption and we're not going to pay any actual income tax, there could be an impact on income tested benefits. So a common one here that we run into all the time is old age security. If you get above a certain level, they claw it back. So we have to be careful of that. The other thing I have to mention here is alternative minimum tax, or AMT. It's not something that we run into very often, but when we use our capital gain exemption, which is what we're talking about here, it can come into play, and it can be significant. It can be upwards of $65,000, $70,000 in a year. What it is, it's a prepayment of tax. So you do have to cash flow it. You have to send it into the government. As long as you're taxable in future years, you can get credit for it. But if you pass away without having fully recouped it, the government's going to keep it. You have 7 years to recover it. AMT only applies if you sell during your lifetime. If you have a capital gain in the year of your death, the AMT doesn't apply. So again, here's our side-by-side. If we're holding the farmland personally, it has to be qualified farm property. There's a complex set of rules. Of course, they're different whether you have a pre- or post-87 acquisition of the land. For this one, you need a continuous chain of ownership. And that's those qualifying persons that I talked about earlier. So if we're looking at the land history and all of a sudden an uncle comes into ownership and then back out again, anything prior to that uncle ownership, we disregard for the purposes of these rules. So that's where, again, that land history is important. If you are getting proceeds over multiple years, you can use your capital gain reserve, which allows you to bring it in more slowly over time, and this can help with reducing AMT, but then on the flip side, we got to watch our OAS implications. If we're selling shares of a corporation that owns land, it has to be a family farm corporation, and again, that means 90% or more of its assets have been used more than 50% in farming. So if you got a corporation that's just full of farmland, as long as you got more farming years than non-farming years, you should be okay. But again, one bad apple can spoil the bunch, so we have to be careful. One thing I forgot to mention, or maybe I mentioned it earlier, but typically once land, personally held land, is qualified for the capital gain exemption, it stays qualified. So that's where you can pass it to the next generation who never has to farm it, and they can use their capital gain exemption. So that's an interesting planning strategy. With a corporation, though, it can very much go offside. And again, it's because it's based on the assets and it's based on the use of those assets. So as you're renting, if that's part of the plan, some of those quarters could fall offside and then all the shares fall offside. So now I want to talk about some common traps. And these are things that it's easy to walk into and sometimes not easy to get out of. The first one is if we have farmland that's owned jointly between siblings, but they're farming it personally. So an example of this might be two brothers. They've decided to buy land together, so they each have a 50% interest in the land, and they're both farming personally. So what this means is neither one of them is technically using the land more than 50%, for farming. And because brothers are not qualifying users to each other, it basically means that the land will never qualify. There's ways to fix this. We could swap land quarters between these siblings. Another strategy is maybe instead of them farming it personally, we could have them farm it in a partnership or a corporation. So there's usually fixes to these scenarios, but we have to have enough time to implement a fix, and we have to know there's a problem. It can't be, the day before we're going to sell, we can't fix it then. We're going to need time. You have to be very careful adding a spouse or a child to land title. Adding a spouse, a lot of folks assume that if both names are on that title, you can access 2 capital gain exemptions. So husband and wife, okay? But if one of those individuals was added to title at a later date, so let's say one of them inherited it, and then they added the other person to title because it made sense from a estate planning perspective, you only get access to one limit. And that's a big deal, because if you thought you had 2 $1.275 million exemptions and you only have one, the tax bill just went up considerably. Adding a child to title, you have to be very careful doing this, because this is technically a deemed sale. You've sold the child that land. And if it doesn't qualify, now it's taxable. So be very careful just, going to the lawyer's office and saying, okay, we're going to add one or more of our kids to title. It can be a taxable event, so just be careful doing that. There's a couple sleeper provisions in there, and one of them is around stepchildren. Now, these are stepchildren that you have not formally adopted. As soon as you formally adopt a child, they are considered your child no matter what. But if I have a stepchild, the reason that they're my child under the Income Tax Act is because of my spouse. If my spouse predeceases me, those children are no longer considered my children under the Income Tax Act. And so if my plan is to gift them a bunch of value, I don't have that option anymore. Another one that I've run into is a child-in-law after your child has passed away is no longer considered a child under the Income Tax Act. And I've seen this in operation, actually. So it was an individual had passed away, left a surviving spouse and children. The parents really wanted the land to go to the surviving spouse because the kids were very young. We didn't have that option, because on the death of their child, that child-in-law is now no longer qualified. So there's some sneaky rules out there that can catch you. Even if you're not trying to do anything funny or get around tax, they can just come up and grab you. Gift hold sale plans. Okay, so I'll give you the scenario here. So I've got some farmland, it qualifies. I want to sell it to the neighbor, but I've only got one capital gain exemption. And that's not going to be enough to cover off all my tax. But I do have 3 kids that live in Canada. So I say, hey, I'm going to gift my kids that land because I can do that. And I'm going to have them sell it to the neighbor. And then because I'm such an awesome parent, they're going to give that money to me as a Christmas present that year. Sounds great. Sounds like a really good plan. Unfortunately, for every good plan, someone at CRA has already thought of that, unfortunately. So for this plan, the child has to hold the land for at least 36 months, bare minimum. If they sell it within 36 months and they use their capital gain exemption, that gift becomes taxable to me. So the kids are fine. They don't care, but dad's not going to get his Christmas present. So I'd be very careful using those plans. They can be used, but it takes a lot of trust and it takes a lot of planning. And I talked about alternative minimum tax, so we have to be careful of that when we're using exemption. And the loss of income tested benefits, so this is your OAS, but it could also be, let's say you're living in a building where your rent is based on your income levels. Well, if you boost up your income levels because of a land sale or a sale of shares, that might mean your rent goes up. And again, I can't warn you enough about the crop share and other arrangements. Typically not considered farming. So I've left the most common trap for last, and it's having no plan. It's being in that 12%, it's being in that 88%, of farms that have no plan with respect to their land. There are tons of rules in the Income Tax Act. There's tons of things that we can do to help, but we need to have enough time to do it, so we need enough runway to implement them. And the starting point first is, of course, which is my call to action, that farmland history report. So if you take anything away from Ag Days, go home, sit down at the kitchen table on a cold day when you don't want to be outside anyway, go through your land. The time to do this is now, because if a parent or grandparent is still with us, I've sat in those meetings. They can rattle that information off. They know who they bought it from. They know the first 10 crops that they grew on it. They know how those crops did. Once those people are no longer with us, all that history goes away. And then it becomes so much harder to put together a land history. So that's my call to action for all of you. Go out, do that land history, and then get in a room with somebody that understands the rules and can navigate and help you out. Because your will might say, oh, these shares go to this kid, that land goes to this kid. You might think you have it all made in the shade. But if we look at your land history and it doesn't qualify, all of that becomes taxable or not possible. So it's extremely important. So that's all for me.